From New York City for viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, this week's inflation data show no signs that pressures are continuing to move higher, while Fed Chair Kevin Warsh reaffirms the central bank's commitment to price stability above all else. And Wall Street's biggest banks tap the debt market after a blowout quarter. We begin with the big issue, the path for inflation.
We haven't got inflation back down to our 2% target in 5 years. Something needs to be done.
I think the Fed should act with even more force in order to reinstate that level back to 2%.
If the Fed gets forced to tighten into an environment that is just thirsty for capital, then you have a problem.
The inflation outlook is starting to turn, but it's very close.
If you were to have a sustained rise in oil prices, and that starts to really weigh on U.S. economic activity, that's a different story.
It's really what's happening to inflation beyond energy prices that's really going to matter.
Overall, we don't have an underlying inflation problem, at least not one that monetary policy can solve.
Ultimately, in the longer run, if you have price stability, that's good for the economy.
To be frank, I really don't see a case for hikes anywhere.
The likelihood that we get this Fed moving to hikes in 26 is low.
So the hard data this week, we got June CPI and PPI show that price pressures are easing. Here's the swaps market's take on where inflation is headed in the medium term. The blue line looks out 5 years. It's the 5-year inflation swap, and it's holding at about 2.4%. But you can see a meaningful drop in the 1-year outlook. That is the white line here. It's now below 2% at 1.94%. That has not happened since September of 2024, before Trump returned to the White House. This chart, by the way, is courtesy of Bloomberg columnist John Authors, who says the swaps market thinks Kevin Warsh will prevail in getting inflation to the Fed's 2% target. Now, sticking with the central bank, Warsh may not be in favor of offering forward guidance, but his focus is clear, and that is fighting inflation.
I reviewed the data on CPI, and it was positive relative to expectations. I'm not going to show up here and say mission accomplished. There's plenty of work to do. The reason I created a task force on data is I don't want to overread or cherry pick data.
Will AI eliminate jobs at a catastrophic rate?
Over the long term, absolutely not. This is a long-term job creator. Will it increase measured prices over the course of the next 12 months? I suspect it will be. But whether that's inflationary or not, that's up to the Federal Reserve. This is one of the good family fights.
Bloomberg's international economics and policy correspondent Michael McKee joins us now for more, with chart in hand, of course. Mike, I want to start at that idea of family fight, because he's invoked that phrase several times. What does that mean to you, and what does that mean for investors who are looking to get some clarity from the Fed chair and from Fed speakers?
Well, the problem is it doesn't really have a great definition. Apparently, what he means is everybody should be free to offer their own opinions, and that there should be dissenting and different opinions on the Open Market Committee as they try to work their way through to what policy should be. But that's always been the case. We've certainly had a lot of dissents in the last few years. So I'm not sure what he means exactly by a family fight, because the members of the committee are very much willing to offer contrary views. But he's got to, at some point, bring everybody together in the idea of what they're going to do. And right now, it does look like they're leaning towards being hawkish.
Okay, so leaning towards being hawkish, and of course, we got the data this week that inflation seems to be moderating. We also got retail sales numbers. Put those together, because gas prices and, of course, oil prices play a big part in both of those.
Indeed. We saw, of course, in retail sales, not a very strong report, a good enough report, but basically Americans kept spending, but they spent on different things. And one of the reasons is because of higher gasoline prices. Now, gas prices did during the month go down, or gas spending did go down by 5.7%. And you can see in this chart here how important that is to overall retail sales. As the national average gasoline price goes up, we see retail sales start to go down because people are spending more at the gas station and less in other spending. Interestingly enough, we had an early Prime Day this month in June, and it didn't produce all that much extra business because I guess people were putting their money into the gas tank. Then we saw in the beginning of July, prices for gasoline start to go down, and you could get optimistic about what might happen for American consumers. And then you look at that chart again all the way over on the right-hand side, and gasoline prices going back up again because the war has resumed. We just had Paul Ryan, the former Speaker of the House, at this conference I'm at, saying that Kevin Warsh has been a longtime friend of his, but he sure wouldn't want Kevin's job right now.
Yeah, walking on a difficult tightrope there. Mike, thank you so much. Bloomberg's Mike McKee, our international economics and policy correspondent. So that's the setup here as we dig into all this with our roundtable. I'm pleased to welcome back Herr. She is U.S. CIO for Global Fixed Income, Currency, and Commodities at JPMorgan Asset Management. And a big welcome to Tony Rodriguez, Head of Fixed Income Strategy at Nuveen. So the big data points this week were the June inflation data, whether it's CPI or PPI. You look at the market reaction in the rates market. The 10-year yield basically unchanged so far this week. The 2-year yield a bit lower. So we've got a steepening yield curve. What does this signal? Is the market not totally convinced, Tony, that the inflation genie has been pushed back into the bottle?
Well, I think the market got some good information, but when you think about what's happening in the Strait of Hormuz with kinetic activity back, oil prices are really a big wild card. To the extent that oil prices remain at this kind of $80 or higher level, inflation is going to be far stickier than expected. Even with oil prices coming down, our view is that inflation is heading in the right direction, but it's going to be a very, very slow decline. So we're thinking still kind of core PC at 3% at the end of the year, 2.5% at the end of next year. So heading in the right direction, in our minds, allowing the Fed to be uncomfortably patient, not needing to hike, but hoping that that outlook kind of is realized, and then they can basically be, off the table for the rest of this year. We think eventually maybe even beginning to cut rates in the first half of next year.
What about you, Kay? Where do you stand?
So I really liked a couple of points that Mike McKee made about the family fight. And I think my family gets along really well, so we don't have a lot of family fights at home. But I think what you really could argue about is what the data shows about history versus what's going to happen in the future. The future is unknown and uncertain, and I think Chairman Warsh is talking about what is the future data going to say. So I completely concur with Tony on the data that we've seen so far. It sure looks like that inflation has been, I'm going to use a word I don't think we're going to see Chairman Warsh use, transitory. It sure looks like it's been transitory. It's such a loaded word. It's unfortunate because in this case, I think it's apt given the supply shock from the activity in the Strait of Hormuz. So I agree that, I thought you had a great chart also that we've got a couple of things. CPI is now lower than it's been since pre-COVID, and inflation break-even, so expectations about future inflation are, I was only going to say they're lower than they've been all year, and you went back to last year. So that is a much better setup. The question is what happens from here, but I completely agree. The Fed's on hold this year. He doesn't need to do anything, and I think I agree, it's not quite mission accomplished, but I think we can, the market's still pricing in one hike this year. I think that will get priced out in the coming months.
It's not mission accomplished when it comes to inflation, and that's because of oil. And we're looking at WTI approaching $80, Brent above 85. I feel like, Tony, we're back at levels where oil starts to dictate moves in the rates market. For a while, that was definitely happening, and then it kind of faded. But now we're back to that kind of dynamic again.
Yeah, and that's because you get the double-edged sword. You get the immediate impact of inflation being higher, but you also have the impact on consumer spending because of elevated gas prices. We're now kind of inching back towards that $4 kind of magic level. So I think that's why it comes front and center. When you think about the inflation story, core goods back to being negative, shelter declining again. So some of the really more medium-term impacts on inflation are really moving in the right direction. It's this energy story that has this double-barreled effect both on inflation and on the consumer that I think the market is grappling with, and the Fed's going to have to grapple with over the next couple of months.
In the Bank of America Global Fund Manager Survey, a record 54% of respondents predict no landing for the economy. 39% see a soft landing and 2% see a hard landing. Kay, does that generally end with inflation and higher rates if you get no landing?
So I think it kind of depends on how things kind of unfold. And I think what's really interesting about this week and the data that we've seen this week is, well, retail sales is a little bit of a non-event. It's not a major data point that the Fed looks at. But if you go back and look at Q1 GDP that came out a couple of weeks ago, what we're seeing is a transition in GDP growth from growth in consumption in terms of contribution to growth in business investment. So I think the no landing camp is that maybe we're passing this baton, and what the consumer does going forward is less important than all of this business investment. Now, of course, to date, something like 90% of that business investment has been coming from AI-related sectors. So I think the more interesting thing now is we're pivoting to earnings. We had the bank start earnings on Tuesday, I guess it was. And so far, that's a very robust outlook. And it's more, what's the broader economic growth? Say, are we going to see this business investment expand beyond AI sectors? We've started to see some of that into other sectors. And I think that's a backdrop that can continue into, trend-type economic growth.
So next week features the hyperscalers' earnings. I believe Alphabet is the first to report, and then the following week, everyone else reports. Tony, is the AI build-out inflationary?
I think in the near term, it certainly is. You're seeing that obviously in chip prices, for example. So yes, in the near term, clearly the demand, because this is such an unprecedented amount of capital investment, we're talking about $800 billion this year, $1 trillion next year. But in the medium term, we think it is unlikely to be. That's going to be more of a monetary policy story. And if in fact the Fed is, true to its word, then we're pretty comfortable that this is not going to be a sustained inflationary impulse coming from the AI, story and the hyperscaler story.
Where do you want to be on the curve, both of you? Tony, I'll start with you.
Sure. Well, we happen to think the long end's kind of pretty stuck where it's going to be. We think fair value is going to be in the 4.25 to 4.5 range for the 10-year, closer to 5% for the long end. We're a little bit above that, so maybe slightly cheap, but we think it's going to be very sticky. So we like the intermediate to 10-year part of the curve. We think we're getting a lot of good carry there. We think there's some possibility for the curve to modestly steepen as maybe that one Fed hike gets priced out, and then as we move into next year. So right now it's that intermediate part of the curve that's more attractive to us.
Okay.
Yeah, I agree with Tony said. I might have a slightly higher end to or higher band on the higher end of the range on the 10-year. I think duration is less interesting here. I think we've got more conviction in investing on the consumer side. So consumer loans, we continue to see strengthening the consumer. And then you mentioned some of the hyperscaler issuance. I think it's less about a particular sector and more about there have been a couple of issues coming in the investment grade market, and maybe the market's less receptive to quick, fast deals. You've had some deals that have come at not as high of at much wider new issue concessions than the kind of 2 bips that we've been running. But overall, the backdrop for fixed income remains strong, and we continue to see very strong flows. So we're more looking at opportunities to put that to work to find good carry in portfolios than focused as much on the duration curve here.
All right, got it. Thank you so much to both of you. Herr of JPMorgan Asset Management and Tony Rodriguez of Nuveen. Still ahead on Bloomberg Real Yield, we'll step outside the U.S. and see how investors may be reaching the limits of their debt exposure to AI. This is Real Yield on Bloomberg. This is Bloomberg Real Yield. I'm Scarlett Fu. Let's step outside the U.S. now for our segment on global returns. U.S.-based data center operator Prime Data Centers delaying a planned $500 million Nordic bond sale. Bloomberg learning that some investors said they would not participate in the sale under the proposed terms. Bloomberg's Eleanor Duncan has been following this story, and she joins us now from London. So, Eleanor, do we understand, do we know what the proposed terms are that investors are not happy with?
We don't know yet, but I think it's interesting because obviously we've seen there is massive demand for data centers across the globe. And to that extent, they are tapping all parts of the debt market right now. We've seen a lot of these deals in the US dollar market. And now I think what's interesting is that they're coming to the Nordic bond market, which is not a very familiar territory for high yield bond investors. So we saw the first deal earlier this year in, I think, May, Polar DC, which raised an $800 million Eurobond there. And now we're starting to see signs of indigestion, which is quite interesting because we haven't seen many of these deals. So with Prime DC, they originally came to the market with a $600 million bond. They later sent word out that they were going to downsize that to $500 million. And then later they postponed the deal for the time being, according to our sources. So we're not sure what exactly the terms were. We understand that Prime DC might be coming back with potentially better terms. But I think overall it's interesting because, the Nordic bond market, not super familiar territory for European high-yield bond investors. For the data center guys, they need lots of cash. So they're looking to the Nordic bond market because it's quicker and it's cheaper because you need less documentation requirements and you don't need a credit rating.
Okay, so that makes it more attractive. And we know these data center operators, all the AI-related businesses are in a desperate cash raising mode right now, so they'll go wherever they can get it. What can you tell us here about the reception from investors going forward to other issues from companies that do similar businesses? I mean, is this company, Prime Data Centers, special in any way in the pushback it's gotten?
I don't think so. I think, to be honest, the response to a lot of these deals has been fairly mixed. So the banks that are marketing them are companies like Pareto and Arctic Securities. They're not your usual, big Wall Street banks like Goldman Sachs and JPMorgan who have the balance sheet to support these kind of deals. I think what is notable is that we're seeing much larger deals than the Nordic bond market is used to. So, for example, Pure DC is floating a $1 billion euro bond, which is very unusual for this size. I think for this market. I think with investors, these companies are different from, say, like the investment grade hyperscalers of the world. These are the data centers, they're burning cash. It's very speculative. They need to build the data centers in order for the tenants to come. And I think a lot of high yield investors are just not comfortable taking that risk. Although some are very excited to get involved in the AI boom too, of course.
Right, with the right numbers in place. Eleanor, thank you so much for putting that into perspective and making the distinction there. Eleanor Duncan of Bloomberg News joining us from London. Now, still ahead, our credit roundtable. We'll be speaking with Meghan Robson, head of U.S. credit strategy at BNP Paribas, and Maureen O'Connor, global head of high-grade debt syndicate at Wells Fargo. This is Real Yield on Bloomberg. It's time now for a moment of interest. Credit rating firms are preparing big changes to how they evaluate CLOs, or collateralized loan obligations. The Revamp puts hundreds of deals and tens of billions of dollars of bonds in line for upgrades, potentially masking risks. Bloomberg's Rachel Graff covers leveraged finance, and she joins us now. So, Rachel, just give us a sense. What's the reasoning behind the changes to the methodology for CLO ratings?
Sure. So Fitch Ratings came out and finalized their changes, and then a few days later, Moody's came out, and both of them have said that this is basically just them updating their methodologies to better reflect the current environment that we are now in. And they're doing that by, for example, updating assumptions around leveraged loan defaults and things like that.
Okay, so what's the expected impact of these changes that they're making?
So that's where it gets a little interesting. They have both said that they expect these changes to result in only upgrades for CLOs. And so, like you said, potentially impacting hundreds of CLOs, tens of billions of dollars worth of bonds, and that makes these vehicles look safer. Some have said that's a good thing. These bonds are underrated. They agree with the ratings agencies. It's overdue, and others have raised some concerns.
Okay, let's talk about the concerns that people have raised, because we've been here before where things that are rated really high, AAA for instance, turns out in a crisis they're not AAA.
That's right, yes. So there's a couple buckets of concerns. One is the timing right now of the market, given the software disruption and the volatility there. Also, the Fed might be hiking interest rates, which makes borrowing costs more expensive. And then, like you said, there are some comparisons to the years preceding the 2008 financial crisis. At that time, some of the ratings agencies did what people have called a race to the bottom, where they were competing for market share by lowering their standards. And since this is only resulting in upgrades now, there have been some comparisons to that pre-2008 competition, and yeah, some concerns around that.
Okay, so, and those are valid concerns. It's been a while, but they still exist. When you talk to people, are those concerns valid that they're competing against each other to rate these securities?
The ratings agencies have said that's not the case. They've said that there are no competition considerations. However, as a CLO issuer, if one of the ratings agencies is going to give you a very positive rating, it makes your bonds look very safe, probably drum up more demand. It's hard as one of their competitors to not follow suit.
Rachel, I think you summed it up really nicely. Thank you so much. Rachel Graff of Bloomberg News covering leveraged finance. Coming up next, we're going to have the auction block. U.S. banks going to market this week, with Goldman Sachs even tapping the euro market, bringing their 2026 debt sales across currencies to $60 billion. This is Real Yield on Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for the auction block, where we highlight the major credit issuance so far this week. Banks have led U.S. high-grade debt sales this week, with Goldman raising $10 billion on Tuesday. Investor demand reaching roughly 3 times that amount at its peak. Now, Morgan Stanley and JPMorgan followed on Wednesday, raising $9 billion each. Bayer and Mitsubishi rounded out the top 5 with their U.S. fundraising units. But Goldman's $10 billion U.S. raise wasn't enough. It also dominated the European bond market, raising 5 billion euros, which is equivalent to about $5.7 billion, that is. That was on Wednesday. That is the second reverse Yankee sale this year for Goldman, and that market is hot in general. 109 billion euros worth of U.S. issued debt has been raised since the start of 2026. And in high yield, U.S. junk bonds are extending their gains as yields fall for a second straight session. Yields actually declining the most in 4 weeks, spurring the biggest one-day gains in more than a week. These gains spanned across ratings in the U.S. high yield market. All right, let's stick with credit. Apollo anticipating more issuance from the hyperscalers. It's a familiar theme.
When you see companies like Alphabet do their $85 billion financing between equity and mandatory, I think the refrain is every precinct is needed. There's a lot of conversations about private credit, about investment grade public credit, about equity. It's going to need all of these asset classes to really contribute, because the vast size of capital needed is really something we've not seen in the past. Hyperscalers were negligible players really in the IG space several years ago. They'll be up to 7 to 10% by the end of this year.
Let's dig into all of this with our credit roundtable. Meghan Robson is head of U.S. credit strategy at BNP Paribas, and Maureen O'Connor, global head of high-grade debt syndicate at Wells Fargo. So I think about what we've heard from the equity side. Bank of America's Global Fund Manager survey found that going long on global chip makers is the world's most crowded trade. About 82% of respondents said that. And in the equity market, we know that that's something people are thinking about, definitely. Chip makers are, of course, the suppliers to the hyperscalers who are issuing all this debt. So, Maureen, I want to start with you. What kind of concentration risk exists on the credit side, on the debt side?
I think we're starting to get to a point where you're reaching a little bit of saturation. Maybe just to put it in kind of index terms, just to give you kind of directionally where we are right now. You mentioned some of the bank supply earlier. The banks are still the largest component of the investment grade index. They represent about 11% of outstandings. The hyperscalers as a group, if you're counting kind of the big 5, represent about 5% of the index. So from an index perspective, it still suggests there's a ways to go before we really reach a meaningful saturation point, especially when you consider that the banks are in the market quarterly, funding fairly efficiently in our market. However, when you reach out the curve, just given the reliance of these borrowers on long duration issuance, the concentration becomes a lot more extreme. So if you just look at the long duration index, hyperscalers are almost 15% of that number, right? And so I think we're starting to get a lot more sensitivity in order books as you see some of these primary deals move through the market around, what types of valuations, what types of new issue concessions are going to be required for investors to buy that next transaction. So there has been a meaningful amount of underperformance in hyperscaler spreads relative to the rest of the market because of this supply overhang. I think right now it's still a valuation question, so it's just a matter of where do these names need to trade from an ongoing perspective relative to the rest of the market to account for that supply overhang. I don't think it's a buyer strike by any stretch, but we are starting to get the beginnings of a market that's starting to get a little bit more disciplined.
Investors are definitely becoming more discerning. And that same survey, Meghan, finds that almost half of respondents, 48%, believe that the AI-linked CapEx is seen as a most likely cause of any kind of systemic credit event. You say we're not in a bubble yet. Why do you add that yet?
Yeah, so we think we're firmly mid-cycle in credit markets. And I think the most important metric to track overall is the aggregate level of corporate leverage. And that has been incredibly stable. For certain pockets of the market, hyperscalers, for example, that is going up. And what we would look at to be more nervous is if you were to see CapEx expectations rise for sectors outside of hyperscalers. So do other of some of these old economy sectors start to participate in the AI build out and start to spend more? In terms of areas that we do think look more bubblish, if you look at IPO activity, it's very, very similar to the late 90s. And if you think about credit markets, that's a risk for us because those could be potentially new issuers in credit, and we've actually seen that already happen. But for now, we do think we're mid-cycle, and that's very much driven by overall stability and leverage.
And I'm so glad you bring up IPOs because Bloomberg reporting that Anthropic's bankers are scheduling meetings with investors in the company in the coming weeks as that AI company gets ready to IPO. Perhaps as soon as October. Maureen, are we going to see Anthropic necessarily follow the SpaceX playbook of a massive IPO followed very quickly by a massive debt raise?
I mean, I can't speak specifically to that situation, but clearly the AI sort of CapEx super cycle is bringing a lot of new entrants into our market, both from sort of a rising star perspective. So issuers coming out of the high yield market into the high G market, we're going to get a lot of new names over the course of the next couple of years, and potentially some new entrants. I think the ratings outcomes on some of these things are going to be, highly scrutinized, at the end of the day, but our market is looking for some diversification, and the pockets are still deep for a lot of these names. So I do like to kind of emphasize that this is a $9 trillion US dollar credit market in the IG space. And because we do have a fair amount of concentration risk, I think some diversity even within the sector will be welcome.
If we do get the big debt issuance from a company like an Anthropic, for instance, Meghan, what do you expect in terms of demand, given the not great performance on the secondary market of NVIDIA and SpaceX bonds? I mean, how are conditions changing, evolving?
Yeah, I think that performance of issuance from any hyperscaler will really depend on how we move through earnings. So exactly 1 week from today, we kick off hyperscaler earnings. We've seen a very consistent pattern leading into that. So 2 weeks heading into earnings, hyperscalers have generally lagged the investment grade market in terms of spread. In its anticipation, as you mentioned, of those CapEx numbers. We don't have much insight yet into official 2027 guidance, but this could be a window where we start to get it. So I think the market is looking for clarity around what is the end? When are we past peak CapEx? If we have that information, I think that the deals can perform better.
So Oracle was downgraded to BBB. It's still investment grade, but without a whole lot of room to spare, Maureen. What's the risk that Oracle gets cut to junk before year end if it announces another massive round of CapEx?
I mean, this is a topic of conversation among investors, clearly, just given the size of their debt footprint. This is almost $100 billion of outstanding bonds. In high yield terms, that would be something like a 6.5% index weight, be more than triple the largest name in the high yield market. I think a lot of things can happen before that name would end up gravitating to high yield. And I think the way that the bonds have traded in the IG market suggests that there's volatility around the name, but they're not necessarily going in that direction. The steepness of the curve, for example, would be one way that I would reference that. But I think, listen, this is the beta bond of our market. Obviously, earnings will inform where that name kind of gravitates to over time. But the spreads leading into the downgrade, I think, already accounted for it. They had a negative outlook already from S&P before the downgrade to low BBB. So I think ultimately the market took that in stride.
If Oracle does get cut to junk, Meghan, how difficult will it be for the high yield market to absorb that much supply? As Maureen said, I mean, its representation will be massive.
Exactly. I think there would be some spread penalty as we migrated from IG to high yield. And we took a look at the sector exposure of aggregate sectors and compared it to Oracle, and that's actually larger than some sectors in the high yield index overall. But I think the biggest implication would be the duration impact. So that's an issuer that has a much longer duration than the high yield index. We don't have a lot of 10-year plus bonds unless they are fallen angels. Mm-hmm. And so that would be a unique feature impacting the overall index duration for high yield investors.
We have a chart from Torsten Slok of Apollo. He points out that the average cover ratio for hyperscaler bonds is declining. It went from almost 5 times in February to below 2 times in July. Now, of course, they're still oversubscribed, but the cover ratio is falling faster than the rest of the market. Maureen, very quickly, what does this reflect to you?
I mean, I think it goes back to the point around investors can be a lot more selective about where they play in the primary market, knowing that these names will be repeat borrowers probably for the next several years. So I think one of the things that these issuers have been thinking very carefully about is how do they diversify their funding footprint as much as possible so that they don't reach this point of saturation where the order books are underwhelming, where the new issue concessions are punitive. For example, this year, about 30% of the issuance that's been done amongst the hyperscaler actually was in non-dollar currencies. Mm-hmm. And you saw records broken in all sorts of currencies that were once kind of considered niche in the capital markets, playing a much bigger role. And I think they're going to continue to be adept at that as they try to minimize both their frequency to market and their size in market, knowing that, of course, the dollar market will always be their core currency of funding.
And Meghan?
Yeah, I think that it does just reflect their investors have more flexibility to participate in deals or not participate in deals. And we've seen continuation of revision of CapEx. People are expecting that we are going to see more issuance. And I think as a result, you can be more selective in what deals you participate in.
All right. And as you said, next week, exactly a week from now, Alphabet will be the first of the hyperscalers to report earnings. We'll see how the market reacts to the CapEx guidance that they do offer. Thank you both so much. Meghan Robson of BNP Paribas and Maureen O'Connor of Wells Fargo. And if you want more talk on credit, check out the Bloomberg Credit Edge weekly podcast on the Bloomberg Terminal and wherever you get your podcasts. Bloomberg Intelligence's Credit Edge, which features my friend James Comby. Still ahead, Morgan Stanley tries to unload its 75-year lease of Chicago parking meters. That's a relic from the financial crisis. This is Bloomberg Real Yield. It's time now for our Muni moment. For almost 2 decades, Chicago has been stewing over a $1.15 billion deal to lease 36,000 parking meters to an investor group led by Morgan Stanley. The city now has an opportunity to do something about it. Bloomberg's Trudy Singh has been reporting on the story, and she joins us now. And Trudy, this is a relic of the global financial crisis when Chicago needed to raise money quickly. What is happening right now that has allowed this issue to come up again? Because it was a 75-year lease, if I remember correctly.
Yes, exactly. In 2008, the city signed a 75-year lease with an investor group that was going to take charge of about 36,000 parking meters. Now, right now, the vote in front of City Council earlier this week was for a Morgan Stanley-led group to sell that asset to a new owner. Now, the City Council was really supposed to, this Finance Committee was supposed to just vote on the transfer, but given concerns that members of the City Council have about just the overall finances of the city and what the city may have lost during the course of the last 2 decades in terms of revenue from the parking meters, this has been something that has come up, and they've been really debating about this. And then now, given the transfer, new questions have come up in terms of what the city's stake potentially could be in the future.
So what do City Council members want? What are they pushing for?
Yeah. So one of the things that a few City Council members are pushing for is potentially a stake or some sort of change in the amount of revenue that the city might be able to get from the parking meters. Now, the City Council isn't really in the negotiations between 2 private entities that are looking to buy and sell this particular asset, but they want to be part of the discussions.
Okay, so they're trying to insert themselves into the process. Why is this so important for Chicago?
Well, just like in 2008, the city currently also is facing a financial challenge. In 2026, the city is trying to close a roughly $1.2 billion deficit. Now, this parking meter deal doesn't directly connect to that deficit for this year, but the city in general is constantly looking for revenue because it has a long-term structural deficit.
And it's looking back to some of the mistakes, or I shouldn't say mistakes, but some of the deals that have been made in the past. All right, Shruti, thank you so much. Bloomberg's Shruti Singh covering munis for us in Chicago. Now, investors also in the muni world placed more than $70 billion in orders for about $2.4 billion of tax-exempt bonds sold by the Aquarian Water Authority. That's in Connecticut to pay for a water company that it's buying from another company called Eversource Energy. Bloomberg's Martin Braun joins us with more. So we're going to get real local here when it comes to Connecticut. Martin, what exactly is the Aquarian Water Authority?
Well, the Aquarian Water Authority was created by the state legislature to buy the Aquarian Water Company, which is owned by Eversource, and provided water to about 60 municipalities, some of which our viewers may reside in: Greenwich, Westport, Darien, and others. And Eversource wanted to get out of the water business. They've had some losses on wind farms, and they had trouble getting the state to allow them to raise the rates. So they found a buyer in this newly created entity.
Okay, why did this $2.4 billion bond sale generate so much demand? I mean, we're talking about more than $70 billion in orders for about $2.4 billion of tax-exempt bonds.
There are a few reasons for that. Firstly, on a baseline, there are a lot of rich people in Connecticut, so there are a lot of people who like to get tax-exempt income. So there's built-in demand for Connecticut bonds. But also, there aren't a lot of issuers in Connecticut that issue this amount of debt, and this was an entirely new name for buyers. So that creates an ability to diversify into a new name. The deal was structured in a way that appealed to all kinds of investors. There were fixed-rate bonds, zero-coupon bonds, insured bonds. So pretty much everyone across the market could participate, from separately managed accounts to individuals to mutual funds, ETFs. And lastly, it was priced pretty cheap to what people may have expected, and that brought a lot of interest into to buy, and they were able to lower the yields and get a better deal for the authority.
Okay, so it sounds like there's something for everyone here, but of course there's a ripple effect, and there is going to be an impact on customers in Southwest Connecticut. What should water customers in Southwest Connecticut expect as a result of this?
Well, what's good for bondholders may not be so great for ratepayers. Their water rates are going to go up. They haven't changed for a while, but with this leverage, they're going to have to increase the water rates, and they could be going up 60% over the next 10 years.
60%.
60.
Okay, over the next 10 years. Martin, thank you so much for bringing us this story. Martin Braun, he is one of our Muni reporters as well here in New York. Still ahead on Bloomberg Real Yield, my final thought: the Federal Reserve setting its sights on getting inflation back to target. Remember, it's that 2% level. This is Bloomberg Real Yield.
Unless I see evidence of a significantly weakening labor market, my focus from here on out will be on inflation. And no matter how you cut it or what measure you want to use, inflation is up this year. Even accounting for the likely temporary direct effects of the oil price shock, it is running at levels inconsistent with the FOMC's 2% objective.
That was Federal Reserve Governor Christopher Waller reinforcing his commitment to price stability, one of the two mandates of the Federal Reserve, which takes me to our final thought. Joining us now is Stuart Paul, of Bloomberg Economics. I turned you into the designer.
Not the first, you're not the last. It happens all the time.
Well, you look like a designer today. Welcome back to Bloomberg Real Yield. Let's talk a little bit about inflation, because we got two inflation prints this week that appeared as if we now have some disinflation, but it feels like a little bit of a red herring, given that we know it lasts until June 30th, and then since then the Iran war seems to be flaring up again, and oil prices have gone back up.
Yeah, it's going to take a lot of energy price inflation to boost headline inflation again. I do think that we've already passed peak headline inflation. I do think that the thing that was most interesting this week from the two inflation prints that we saw was that it's really the core that's surprising to the downside. We all anticipated that disinflation within energy was going to drag down the headline, but it was really the miss in the core for both CPI and PPI that mattered most. And in particular within the CPI, and most relevant for our Fed policymakers right now, is computers, electronics, and things that have semiconductors like appliances really surprised the downside in that core CPI report. And for the Fed right now, they're really focused on the extent to which easy monetary policy right now is facilitating the AI build-out, demand for chips, and they're watching for evidence that that's bleeding into consumer prices. To see that miss in the June CPI print was really important.
Okay, so we're going to be getting more evidence, more anecdotal evidence as companies report earnings. Next week, we've been saying that Alphabet will be the first of the hyperscalers to report, so we get some sense of CapEx. But as we go further into earnings season, we'll hear about how companies themselves are adjusting to higher costs. What will you be listening for as an economist to make your adjustments on your end?
Well, exactly to your point, I'm really focused on CapEx and CapEx plans. I'm increasingly focused on identifying the extent to which CapEx is going to be dependent on imported goods from abroad, because that's going to materially change how we end up netting out the effect of that CapEx build out on GDP. We're subtracting out imports, so we might not see as much of a growth impulse for the headline GDP number as the CapEx plans would imply. We need to get the GDP accounting right on that front. And then beyond that, when we see these CapEx plans and we hear about a real focus on efficiency gains, the thing that I'm going to be laser focused on in every quarterly earnings call is real gross revenues per employee. There's a lot of attention being paid to whether the implementation of AI is starting to lead to less demand for labor. But it looks to me like a lot of the high-profile layoff announcements that we've seen are at companies that have had declining real gross revenues per employee, and so it almost looks like AI washing. So I want to stay focused on whether or not there's actual efficiency gains in the announcements and plans.
Okay, may not show up this earnings season, but certainly a theme to come for many earnings seasons in the future. Stuart Paul of Bloomberg Economics, thank you as always. From New York, that does it from us. Same time, same place next week for Bloomberg Real Yield. Keep it right here on Bloomberg Television, because Balance of Power in Washington is up next. This is Bloomberg.